Hi, I'm Tanya van Lill. I'm the CEO of the Southern Africa Venture Capital and Private Equity Association, SAVCA, and we look after private equity and venture capital fund managers in the Southern Africa region.
My name's Cassim. I am founder of Jozi Angels. We are a group of angel investors based in Johannesburg.
My name is Juliette Thirsk. I am a commercial attorney. Founded my own firm with my partner Shelley about 7 years ago, Brevity Law, and we work on a wide range of commercial transactions and happily have also been involved in the early stage investment space for the last couple of years.
We've actually seen a lot of growth in the early stage ecosystem in terms of investments. There are more fund managers that are investing into early stage and startup businesses. There are more angel investors that are investing. And particularly in 2016, we've seen an exponential growth in investments, and both from a number of investments, but also from the actual funds that are being invested.
The ecosystem has grown tremendously, and particularly from a legal perspective, it's the legal landscape has lagged behind quite a bit compared to other jurisdictions, for example, the United States, where the ecosystem is incredibly active and the legals around that have sort of kept pace with the ecosystem, and that there are fantastic precedents available that are quick and easy for people to use without having to spend a lot of money on legal fees.
So if you look at South Africa's biggest exits, there have been quite a few that have reached the $100 million mark. The biggest of which is still Mark Shuttleworth's company that was sold in the 90s for $575 million. Kappa Biosystems was sold for $445 million. Get Smarter is probably the most recent acquisition, and that was sold for $123 million. And then Fundamo was sold for 110, and a company called Numbula, was sold for 110 as well. We've seen quite a few exits, predominantly in the Cape. So if you look at our top 10, 8 of that top 10 were based in the Cape, in the Western Cape. But we are starting to see other ecosystems mature and start to contribute more effectively to our national ecosystem.
So in terms of barriers to entry, there's barriers to entry in terms of the actual entrepreneurs having access to capital. But as an investor, it's knowing where the funding gaps are in the landscape and knowing where you can play a role, and either going it by yourself, or rather engaging with others in the industry and learning from them and co-investing with them. It's a very lonely road if you try and do it yourself. But as far as possible, educate yourself on the opportunities, educate yourself on some of the terms being used, term sheets, the language that's being used, how these companies should be evaluated. So it's really more about a knowledge and experience base that might be a barrier to entry than anything else. A lot of them invest in the early rounds of the growth businesses, Series A and Series B, as we like to call it. But as these companies start to grow and mature and really need funds and capital to scale, we don't have enough investors and fund managers that can co-invest and that can really help these companies grow the way that they need to. And a lot of times we see that international capital needs to come in to help with this particular growth.
There is, I think, as a lot of people may know about, there is this Section 12J tax incentive, which is available for investing into SMMEs and qualified companies. And that's been very, very successful. But unfortunately, I think it's due to be coming to an end and expiring in the middle of next year, June 2021, I think. So if you are looking to become an active angel investor, it's probably the window to take advantage of that incentive is closing. And secondly, it's the type of thing where you could still probably get involved as an angel investor by investing in the established 12J funds that are out there. That's obviously an option that's still available to you for the next tax year. But that is going to be, I suppose, relatively passive in investing, because you will be giving your money to a fund and then they will be making those investment choices for you. I would say that at the moment, convertible loans or convertible notes are very common and popular, and they're great instruments because they can sort of toe the line between being simple and not requiring a huge amount of drafting, but at the same time they're secure. I use the word secure lightly, but as an investor, you have a loan, and the company that you're investing in is indebted to you in an amount equal to that loan, whereas a safe is slightly more risky in the nature of what that instrument is. So the convertible loan sort of strikes a nice balance with simplicity, but also providing the investor with a little bit more security, but also being able to be exposed to the upside of a potential investment. So we're seeing a lot of those, and less equity.
So it's a maturing ecosystem, and think of it as a rising tide that's going to lift all boats that are participating and part of the ecosystem. The second reason is that it's relatively affordable and accessible when compared to other markets, even on the continent. We're seeing big capital raises in the seed and Series A rounds elsewhere, and significantly lower capital raises locally. I think that's partly due to our cost of living in South Africa versus other markets, and partly due to the maturity of our ecosystem. But think of it in the same way as China has its competitive advantage in the manufacturing space. We've got a particular competitive advantage in the tech ecosystem, in that we're able to produce things a lot cheaper than you'd be able to produce it elsewhere. And then lastly, I think we've got a strong business environment which is supporting us. This business environment is comparable to other parts of the world, other developed markets. And as I mentioned earlier, they are more open now to investing and working with startups than they were previously.